The evidence that passive index investing outperforms active management is well established in equity markets, where over 85% of active managers underperform their benchmarks over 10-year periods. Early analysis of institutional crypto fund performance is suggesting a similar pattern. Most actively managed crypto funds have underperformed simple Bitcoin or Bitcoin Ethereum equal weight benchmarks over comparable periods, despite charging significantly higher fees and employing sophisticated trading strategies. This performance evidence creates an institutional allocation framework question. For institutions that want diversified crypto exposure beyond Bitcoin, does a passive index approach, holding a rules-based basket of the largest cryptocurrencies, provide better risk-adjusted returns than active manager selection, which requires significant due diligence, higher fees, and ongoing manager monitoring? The early evidence suggests yes, though the crypto market history is short enough that definitive conclusions are premature. This analysis covers the crypto index fund product landscape, the index construction methodologies and their institutional appropriateness, the rebalancing mechanics and their tax and cost implications, and the framework for institutions deciding between passive index, active management, and hybrid approaches to crypto portfolio construction. Market cap weighting for crypto indexes produces a portfolio that is naturally concentrated in Bitcoin and Ethereum because these two assets represent the majority of total crypto market capitalization. The Bitwise 10 Crypto Index, the most widely tracked institutional crypto index, weights Bitcoin at approximately 65 to 70% and Ethereum at 15 to 20%, with the remaining 10 to 20% distributed across the next largest assets by market capitalization. This concentration reflects the actual market structure rather than an equal weight approach that would overrepresent smaller, less liquid assets. The liquidity and eligibility criteria are the most important methodological choices for institutional appropriateness. Indexes that include assets with limited trading venue coverage or insufficient institutional custody availability create operational problems for institutional replication. The CF benchmarks and Bitwise methodologies specifically address institutional requirements. Included assets must be available through regulated trading venues, must have institutional-grade custody solutions available, and must meet minimum trading volume thresholds that allow institutional-scale position sizes. Quarterly rebalancing creates an interesting institutional dynamic in crypto markets because the rebalancing trades from large passive vehicles can have observable market impact. When a major crypto index rebalances its constituent weights quarterly, the buying and selling required to realign to new market cap weights can move prices for the affected assets. This rebalancing impact is both a cost for the index fund and potentially a signal for active traders who can predict the rebalancing trades from publicly available index methodology documentation. The institutional crypto index product landscape is substantially less developed than the equity index fund market, with total assets under management across all major products well below $2 billion compared to tens of trillions in equity index funds. This underdevelopment reflects both the relative youth of the institutional crypto market and the absence of broad distribution through traditional financial advisor and institutional channels that has driven equity index fund growth. Bitwise has established the most credible institutional index franchise with the Bitwise 10 Crypto Index Fund, which has SEC reporting status and a track record extending back to 2017. The fund's quarterly rebalancing, clear methodology documentation, and institutional custody arrangement with BitGo have made it the reference product for institutional passive crypto exposure. However, the Bitwise 10 trades at a premium or discount to net asset value, rather than offering the daily NAV-priced access that equity index fund investors expect. The CF Benchmark Suite, published by Kraken's Benchmark Services subsidiary, provides reference price indices that underlie Bitcoin and Ethereum ETF pricing and many institutional derivative products. While CF benchmarks are primarily price reference tools rather than investable products, they represent the most institutionally rigorous price methodology in the crypto space, with FCA-regulated status and methodology documentation that meets institutional transparency standards. The passive versus active performance comparison in crypto markets is complicated by the relatively short institutional track record available and the extreme cyclicality that makes time period selection significantly influence results. However, the evidence available suggests that the institutional equity market pattern, where most active managers underperform passive benchmarks net of fees, is also emerging in crypto markets. The fee structure comparison is particularly unfavorable for active crypto management. A typical institutional crypto hedge fund charges 2% management fee plus 20% of profits. In a year where Bitcoin returns 100%, a hedge fund manager who simply holds Bitcoin would owe the 20% performance fee on the gain, effectively returning approximately 82% to investors while keeping 18%. A passive Bitcoin ETF at 0.25% fee would have returned 99.75%. The active manager would have needed to significantly outperform the passive alternative to justify the fee structure. Crypto markets have several characteristics that academic literature suggests should favor active management over passive. Higher information asymmetry than developed equity markets, significant mispricing from retail sentiment cycles, and technical analysis trading that creates predictable price patterns. Despite these theoretical advantages for active management, the empirical evidence from the limited track record available suggests that crypto active managers as a group have not consistently generated returns sufficient to justify their fee premium over passive alternatives. The crypto index return decomposition reveals several analytically important components. The rebalancing return contribution is particularly interesting in crypto markets because crypto assets exhibit both strong momentum during bull cycles and dramatic mean reversion during bear cycles. In a sustained bull market, the quarterly sell-high buy-low rebalancing creates a systematic drag relative to a buy-and-hold approach in the top-performing asset. In a bear market recovery, the systematic purchase of underperforming assets can create a positive rebalancing contribution if the underperformers recover. The practical implication of the rebalancing dynamic is that crypto index funds perform relatively better versus concentrated single-asset holdings during periods of volatile market rotation and relatively worse during sustained single-asset bull markets. An institutional investor who had held only Bitcoin throughout the 2020 to 2021 bull market would have outperformed any diversified crypto index because Bitcoin's appreciation was concentrated enough that diversification created drag. The management fee comparison across institutional crypto index products reveals significant fee variation that compounds meaningfully over multi-year holding periods. A fee difference of 0.5% per year between two index products might seem modest on an annual basis, but represents a meaningful cumulative difference over a 10-year institutional holding period in an asset class where total returns can be significant. Institutional investors should prioritize fee minimization among index products with equivalent methodologies. The Bitcoin concentration risk in market cap-weighted crypto indexes is the most significant practical limitation for institutions seeking broad crypto diversification through passive products. An institution that allocates to the Bitwise 10 expecting meaningful exposure to the broader altcoin market will discover that over 80% of the portfolio is in Bitcoin and Ethereum. For institutions already holding Bitcoin directly, an index fund that is 65% Bitcoin provides limited additional diversification. Equal weight or alternative weighting methodologies address the concentration issue but introduce different problems. An equal weight index that assigns the same allocation to Bitcoin and a mid-cap altcoin is giving equal weight to assets with dramatically different liquidity, market maturity, and institutional track records. The equal weight methodology may appear more diversified while actually increasing exposure to lower quality assets in the institutional quality spectrum. The regulatory status complexity of institutional crypto index products requires institution-specific legal analysis rather than generic investor guidance. Some products are open to institutional qualified purchases, others require accredited investor status, and some have minimum investment requirements that effectively restrict access to the largest institutional allocators. The product selection process must include regulatory eligibility verification as a prerequisite step. Crypto index investing represents an institutional allocation approach that is likely to grow significantly as spot Bitcoin ETF approval opens the door to broader institutional passive product development. The regulatory infrastructure now exists for passive crypto index products in the ETF format that would provide institutional investors the NAV-priced, daily liquidity access to diversified crypto exposure that currently requires OTC relationship access. The institutional case for passive crypto index investing rests on the same evidence base as passive equity investing. The combination of fee drag and market efficiency makes consistent active outperformance rare across large institutional manager populations. This argument is strongest in more mature, more efficiently priced segments of the crypto market and weakest in early stage, information asymmetric segments where specialist knowledge can generate genuine alpha. For institutions building their first crypto allocation, a passive approach that starts with direct Bitcoin ETF exposure and potentially adds a diversified crypto index fund provides a clear, defensible, and administratively simple portfolio structure. This approach can be implemented with minimal crypto-specific expertise, provides benchmark relative performance attribution, and positions the institution to evaluate active manager alternatives with the passive baseline as the reference point.